American Express is a company that Warren Buffett himself holds. As we can see here, it is around 8.18% of his portfolio. However, looking at the performance, this stock is up 37% over the last 12 months. So is it looking overvalued? Is it one we should be considering selling? What are our thoughts? Let's do a deep dive in today's analyst. And we can see and look at their top line revenue increase over the last few years. We'll also analyze their bottom line net income and look at the health of the company, their total cash versus their total debt. We'll also see how they're performing versus others in the industry over the last few years. And we'll see not just what the institutions are doing, whether they are buying or selling, as well as the most recent quarter, but we'll look at insiders, notably 42 million worth of shares sold over the last 12 months. And importantly, we'll look at both dividend safety and look at their financial metrics to see whether or not this is a company that continues to grow over the last few years as well as expected in 2024 and beyond. Don't forget, we will run them to the valuation model, getting to our intrinsic value so we can find our acceptable buy price given our investor margin of safety and look towards Wall Street to see their price targets for the next year. Now, firstly, while looking at their historical performance, we can in fact see that a very strong performance over the last year, but over the last 10 years, also a fairly decent performance, up 160%. Now, this doesn't include those dividends reinvested, which is currently a yield of 1.3%, and they do trade at a fairly reasonable PE, forward-looking of 17.3. Now, we have both a Seeking Alpha analyst and Wall Street analyst declaring this still a strong buy now, and that is the aim of today, to understand whether or not it's undervalued, overvalued, or just a simple hold. So let's take a look at their top line revenue. Now, we want to see 3 to 7% growth year on year. What we know over the last 10 years, 32 billion in December 2014. Latest annual accounts, December 23, 56 billion. So it has grown over the last 10 years, but what I would point out is a lot of inconsistencies, a lot of years where the top line did remain flat, and in fact some years where in fact the top line did drop. Now, looking at it, we can see nonetheless it does move in the right direction, but we aren't talking about a company that is growing at a very fast rate, and we can look at the last 10 years percentage-wise very soon. Bottom line, how does that compare? Well, again, pretty similar to the top line. We do see growth, nearly 6 billion of net income in 2014, 8.4 billion in 2023. But again, year on year, we are seeing decreases, flat, dropping, increasing, so very inconsistent. And nonetheless, it is moving in the right direction, but similar to American Express's top line revenue, this isn't a very consistent company, and we will factor that into our investment thesis, as well as when we look at our margin of safety. In terms of cash and equivalents, well, 22 billion in December 2014, they have more than doubled that to 46 billion from their latest report. And when we do take a look at the graph, we can see their cash position has been pretty much trending upwards over the last 10 years, which is a fairly positive sign. Now, in terms of their total debt, what we can see has decreased over the last 10 years, marginally though, from 62 billion down to 61. And when we do take a look at it in terms of a bar chart, very inconsistent. Some years it does decrease, does then increase. So again, you can't really put your finger and say that they are looking to decrease their debt over the period. But ultimately, both top line, both bottom line, as well as cash and debt is very inconsistent with this company. And we'll take a further look when we analyze their metrics. Now, in terms of how they've performed versus others in the consumer finance, Capital One, Discover Financials, we can see that over the last year, including dividends reinvested, in fact, they were a very strong performer. I would be happy personally with a 39% increase over the last 12 months. Well, look, in fact, they are one of the worst performing of the industry. We have Capital One up 52%. We have KSPI up in the triple digits, and SYF as well as Ali up very strongly as well. So we can't really compare them to competitors and say they've performed poorly. In fact, over the last year, I would say a pretty strong return. When we maximize it to the last 5 years, we do see they are the second best performing, up 117%. Over the last 10 years, we go up 205, again the second best performing. So when you do zoom out, American Express does typically perform very well, not just in isolation, but also versus their competitors. Now, in terms of how they look in terms of institutional ownership, 84% currently. We do know around 7.74 billion worth of sales over the last 12 months. with a little bit more buying over the same period, 11.4. So we can see when we do look at 2023, more buying than selling in Q1, Q2 and Q4, with more selling in Q3. Now when we do take a look at Q1, we do see more selling than buying, but this data set isn't complete yet. So overall, as we can see on a 12-month basis, institutions are buying more than they are selling. Now, never do what institutions do and always do your own due diligence. Never copy any other's trade. Now, insider buying, insider selling, well, we do in fact see in Q1 a large amount, 42 million worth of insider selling. When we do take a look and analyze the actual insiders, we do note here that an insider, Lauren S., did in fact sell 84,000 shares on the 12th of February, amounting to $18 million. We also note the CEO, Stephen, did sell on the 12th of February just under 70,000 shares of 14.8 million. Now, yes, this is something, again, factored into your investment thesis, but never solely look as insider selling as something you should copy, buy, or sell, both in the same eyes. In my opinion, insider buying, whilst it is bullish, again, it doesn't mean you should just copy it because insider buys. Insider selling, again, the same should be said for that. Now, just to let you know as well, we have literally just a few hours ago released our latest free weekly article. We're looking at undervalued dividend stocks. If you want to gain access to this, as well as other articles, all completely free, instant access, do click on that pinned comment below and sign up. Now, in terms of dividend safety, score of 80, it does look to be safe. Market cap, 158 billion. It is a mega cap company. In terms of recessionary metrics, well, last recession, whilst they didn't increase the dividend, they didn't cut it, they did in fact maintain it. They did have below average growth, negative 20% versus the S&P's negative 12%, but they did in fact return a much worse performance, negative 82%, trailing the S&P's negative 55%. Dividend growth, lots to love here. We had a 17% increase just a few months ago. Double-digit increase over the last 5 years, double-digit increase over the last 20 years, which is a very positive thing for dividend growth investors. Now, whilst we do know they have been increasing the dividends, they've only had 2 years of consecutive increases. As we see, the dividend was held from 2020 to 2021, although they have been paying a dividend for the last 28 years without reducing it. Now, taking a look at dividend yield theory, for those that are new to the channel, it does state a company is undervalued when the current yield sits below the 5-year average. What we can see here, it is slightly lower, so you could argue reasonable valuation. You could argue slight overvaluation. On the forward P, the same could be said. It is slightly higher than the 5-year average, so you could argue reasonable / slight overvaluation. And when we compare it, it is much higher than the financial sector P of 11.8. One key thing to understand is, though, we're not looking at any single model in isolation, and we do conclude towards the end. In terms of the payout ratio, always we focus on the free cash flow, below 60% for the majority of companies. Quite simple, the reason we do expect, if it is much lower than 60%, that companies can offer double-digit increases like American Express have continually done. In fact, it is below 20% for every single year bar 2020, and the last 2 years, in fact, 8 to 10%, looking very healthy. So I would expect another strong double-digit dividend increase from American Express next January, unless we do see a very large recession. Now, in terms of free cash flow per share, again, pretty much what we were echoing across the beginning of this episode. Very inconsistent. The numbers do increase, both revenue, both bottom line net income, as well as free cash flow. But you do know year-on-year inconsistencies, year-on-year flat, some years decrease, some years increase. So again, just try to understand the type of company you are investing in. And when we do focus on the sales growth, remember 3 to 7%. Whilst it is inconsistent, one thing I would take away from here, on average, very strong growth. In fact, look at the last 3 years, we're looking at double-digit growth, although we do know what a company, or in fact, what an event like COVID does have on this company, negative 22%. And as we saw earlier, something like this really only comes around on these one-off events or when we do have a recession. So again, factor that in to your investment thesis and factor that in when we look at your margin of safety. Total sales then, we did run through that, but you can see it again here in a different format. Shares outstanding, one thing they do very nicely is returning that excess cash. Remember, when companies do share buybacks like American Express are doing, reducing the count over the last 10 years, very healthy, nearly 30% in fact, giving you more ownership over the company. So that is a nice thing to note and very attractive for potential investors. Return on equity, well, we want to see 10% or more, as I always say. Very strong, very healthy, and even very consistent in the fact that 2020, where they had one of the worst years, it was 14%, rebounded very strongly to the mid-30s, and even when it dropped again to the low 30s, this is still a very strong company when factoring in the return on equity of your investment. Now again, what we can see here on the free cash flow margin side, well above the minimums 5% that we do want to see year on year. Very consistent again when you do factor in that pandemic year was very poor for the majority of the companies. It is coming at a low 30 nearly every single year. So again, something very, very positive to note. Now, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, when we're looking for below 3, this does signal both dividend safety as well as balance sheet strength. 2023 at 0.86, very healthy. 2024 expected to go lower. No real worries. Whilst we do know the inconsistencies on the balance sheet, there are no worries that we have with this dividend safety and the balance sheet based on the information that we have today. Now, in terms of the valuation, and don't forget, as always, if you do enjoy the content, value is being provided, to smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. We will move to the first valuation model, which will be Graham's formula. Now, we have the stock ticker symbol, we have the earnings per share, we have the long-term growth rate and corporate bond yield at 5.12, giving us an intrinsic value here, not too far off the market value, but we do get our first sense of overvaluation. Again, it's key to understand that we are not looking at any one of these models in pure isolation. The next model is the dividend discount. Now, we did see, as we mentioned, it did remain flat for 1 year not too long ago, but on average still very healthy at over 10%, so in the double digits. Now, forward looking, we have estimated a more conservative outlook at 6.75%, and we do know here an undervaluation signal, again very marginal though based on the current market value. We then get to the DCF model with the free cash flow year on year. As we can see, very inconsistent. Some years we'd see negative double digit, some years we see positive double digit growth. On average though, 28%. We have tried to be a little bit more conservative, especially with the unknown and potential recession coming into 2024-25 at 4%. With the essential discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by those shares outstanding, and we get that intrinsic value. So we do in today's episode have 2 undervaluation signals and 1 overvaluation signal. Do bear in mind though, you can also grab a copy of this valuation model so you can get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio, as well as those on your watch list. Or even if you want to run through these companies again but put your own percentages, you can by clicking below. So a margin of safety, as always, we do use 10%, and we use that if we meet 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. So at 10% for today's episode for AXP, it isn't a buy now at 212, given that isn't the current trading price. So right now, it only gives a margin of safety of 5%. Again, if you were looking for 10%, it would be a buy at 212, 15% at 200, at 20% at 189, and for those seeking value, around 25% at 177. So based on a 5% margin of safety, you would be looking to buy it around the current value. Now, Wall Street, in terms of what they're looking at, they see upside of really only 3%, price forecast of $230. Now, this isn't a company that I do own. It isn't in my portfolio, and personally, if it was, right now I do see the share price has gone up very rapidly over the last 12 months. Looking at the numbers, there isn't anything that I have seen for me to believe it warrants it. So if I was holding it, personally, it is one that I would consider either to hold or potentially sell if there were better opportunities out there in the market. Again, it does come down to your own investment thesis for this company and for the market as a whole. As always though, do let me know your thoughts in the comments below. Is American Express one you're looking to add? Maybe you're also looking to sell, or in fact, if you do hold a portion of this in your portfolio, you may want to hold it. And to be honest, it does have some very strong dividend growth, and we've seen 10% on average over the last 20 years. As always, let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.